What does it mean when a city once lagging in office demand suddenly sees the highest increase in demand since the pandemic? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a striking development, San Francisco has experienced the strongest quarter-over-quarter increase in new office demand in the second quarter among the 7 major markets that are tracked by the real estate software company VTS. This marks a significant leap towards recovery for a city that had long been the worst performing in terms of new office demand. The San Francisco Business Times reported this turnaround on August 14, 2025, highlighting a pivotal shift in the city's commercial real estate landscape. The data from VTS suggests that San Francisco is hitting a tipping point in the return to office scenario, signaling renewed signs of life in the Bay Area's economy. This uptick in demand reflects a broader trend of economic revitalization that is being observed across various sectors. While the city had faced challenges, including tariff impacts on office leasing, this new trend suggests a potential new gold rush for the Bay Area, albeit with some cautionary notes. In a significant move reflecting the intense demand for rental properties, the Hankin Group is set to invest over $150 million in 3 major projects across Chester County, Pennsylvania. This development comes as the suburban Philadelphia apartment market is recognized as one of the most competitive in the United States. According to a report by Ryan Mulligan of the Philadelphia Business Journal, dated August 14, 2025, the projects will add hundreds of apartments to the area, catering to the strong rental demand that has characterized the region. This investment by the Hankin Group underscores a broader trend in the multifamily property sector, where developers are increasingly focusing on suburban areas with high rental demand. Chester County's strategic location, coupled with its appeal to renters, makes it a prime spot for such developments. The projects are part of a larger vision to create vibrant, community-centric living spaces that are well connected to urban centers. Bianca Barragan of Southern California reports that investment in United States retail real estate has surged, exceeding historical averages in the first half of 2025. According to the JLL Retail Market Dynamics report, investment volumes rose by 23% year-over-year to $28.5 billion. While this figure is below the recent peak of the first half of 2022, when sales volume exceeded $40 billion, it is a significant increase compared to the first halves of 2023 and 2024. Despite the increase in sales of retail properties, the construction of new retail developments has struggled. Construction starts in the first 2 quarters were down by 50%, totaling 4.9 million square feet. The report notes that much of the available retail space was built in the 20th century and is of unexceptional quality. With new space being scarce, retailers are quickly leasing existing spaces, with tenants signing new leases within 7 months of the previous store's closure. This marks the shortest lag period in more than 20 years. The report highlights that development activity is unlikely to pick up until the economics of speculative building improve. Currently, the costs related to constructing new space outweigh the potential rental income from completed spaces. Nationwide vacancies remain steady at 4.3%, with approximately 6,600 announced openings surpassing 5,600 closings. Notably, most openings are occurring in spaces 10,000 square feet or smaller, while closures tend to be in spaces between 10,000 and 50,000 square feet. In a noteworthy transaction, Terreno Realty Corporation has expanded its industrial real estate holdings with the acquisition of a property in Woodinville, Washington, for $232.6 million. This move aligns with Terreno's strategy to enhance its presence in key logistics markets across the United States. The property, which boasts approximately 500,000 square feet of industrial space, is strategically located near major highways and transportation hubs, making it an ideal addition to Terreno's portfolio. This acquisition underscores the growing demand for well-located industrial properties, as companies continue to focus on optimizing supply chain efficiencies. The Woodinville property offers significant potential for Terreno Realty to capitalize on the increasing needs of e-commerce and logistics firms. As the industrial real estate sector remains robust, with low vacancy rates and rising rental rates, investors like Terreno are keen on acquiring assets that promise stable and long-term returns. In the context of the Canadian market, particularly in regions like Kitchener-Waterloo, London, and Cambridge, Ontario, there is a parallel demand for industrial properties. These areas are experiencing a surge in interest from logistics and manufacturing companies seeking to establish or expand their operations. While the scale may differ from major U.S. markets, the underlying dynamics of supply chain optimization and e-commerce growth are driving similar trends in both countries. The American perspective on industrial real estate, as highlighted by Terreno's recent acquisition, provides valuable insights for Canadian investors and developers. By understanding the strategic importance of location and the evolving needs of logistics providers, stakeholders in the Canadian market can better position themselves to capitalize on these opportunities. The cross-border relevance of these trends emphasizes the interconnected nature of the real estate markets in North America. In Scottsdale, Arizona, a significant office lease agreement has been signed, marking the largest in the valley for the year 2025. Troon, a global leader in golf and club-related leisure and hospitality services, has committed to a substantial office lease that underscores the ongoing demand for office space in the region. This lease is a testament to Scottsdale's appeal as a thriving business hub, attracting companies looking to establish or expand their presence in the area. According to Jorge Ramos, this transaction highlights the resilience of the office market in Scottsdale, despite broader challenges faced by the office sector globally. Troon's decision to secure such a significant space reflects confidence in the local economy and the strategic advantage of being situated in a region that offers a blend of quality lifestyle and business opportunities. The deal is expected to have a positive impact on the local real estate market, as it signals continued interest from major companies in securing office space in Scottsdale. This aligns with trends observed in other dynamic markets, where businesses are prioritizing locations that offer both operational benefits and an attractive environment for employees. As we look at the broader implications of this lease, it becomes evident that while some markets struggle with office space vacancies, others like Scottsdale are thriving, driven by strong economic fundamentals and a desirable quality of life. This dynamic is mirrored in certain Canadian markets, such as Kitchener-Waterloo and Cambridge, Ontario, where there is also a notable demand for office spaces that cater to the needs of modern enterprises. The cross-border relevance of these trends suggests that understanding local market conditions and strategic positioning can offer significant opportunities for both American and Canadian real estate investors. As businesses continue to adapt to the evolving landscape, regions that can offer a compelling mix of economic potential and lifestyle benefits are likely to remain attractive destinations for corporate investments. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.